So I did a little math, and back in 2016, I actually warned a variety of different people about my predictions for the US economy, the state of the US economy for the time to come. And this is back in 2016. I think I was a junior in high school. Um, and like many of you know that are watching this, that know me personally, knows my striving and very intensive passion for finance and economics and whatnot. But anyways, back in 2016, I was warning everybody, right? I was warning that a recession was not only bound to come, but it's going to be the biggest one ever, right? Because this massive accumulation of debt, this debt monetization that we're seeing right now is over the top, right? There's you might as well call this money, this so-called fiat currency that we use as our world's reserve currency, right? The US dollar. You might as well call it fake money, right? You might as well call it fake money because all it does is provide an inflation adjustment to your nominal return. So what people don't realize is your real return is taking into account inflation. That's why people invest in TIPS, right? Treasury inflation protected securities. And these TIPS are supposed to protect you from inflation. And right, hyperinflation, which we're not seeing yet, but we are seeing inflation in consumer prices right now. But once we make that transition to higher inflation, the Fed can't do anything about it. The government cannot do anything about it. They can't stick idly by it. They can't ignore it like they did back in '08. They can't ignore it like they did in '01. And even in 2011, when the US dollar was really, really weakening. But speaking of the dollar, right now, the DXY, the dollar index, is actually underperforming in the most recent days. And I think it's at like 97 or maybe even below that. But we've been stagnant in this kind of channel in the dollar index for about a decade, right? It's been about a decade before the dollar index has actually made a tremendous move to the upside or downside. But realistically speaking, if you take a look at the price action, the general trend of the US dollar, you'll see it's been decelerating for quite some time, longer than a decade, in fact. Right, even after the 80s, when we had interest rates in the teens, that's really when the dollar started to decelerate in this kind of macro trend to the downside. But nevertheless, how does inflation encounter us in our everyday lives? Well, in this case, especially through consumer prices, right? And the reason why people claim that this may actually, in fact, be a deflationary, right? A deflationary recession, which they're totally wrong, right? Deflation is actually a really good thing. It lowers the cost for, it lowers the cost of living for the average consumer. But not only that, but on the business side, right, in the private sector, it actually lowers the cost of doing business, the cost of goods sold, whatever you want to call it, for an average business, right? Because a price of a basket of goods will generally come down in price with deflation. So deflation is actually a really good thing. That's actually what we want. But since we've been in the United States under what was and kind of still is for the Federal Reserve inflation rate target of 2%, and we haven't even managed to get over that or even to 2%. Now I think we're trending a little bit at that range and a little bit over. But that's because inflation is really picking up due to our debt monetization, due to that magic printing press that we have been so accustomed to over the years, really since after the gold standard, after Nixon did all that crap. And well, you could say he made a really bad move. And he really did, because the gold standard benefited a preservation of wealth, right? That was the value proposition for the average American citizen, right, was to preserve wealth through a commodity, through a world's reserve currency, what was anyways. Before the 60s, throughout the 60s, presidents were just trying to do everything they could to deplenish the value of gold and to move further to a more common standard, which today is the fiat currency, today is the US dollar. But no, inflation's a mystery, right? Inflation is, the definition is when, a price of a basket of goods moves up in value, right? Those prices go up. And, it's typically due to, a humongous, yeah, you could say it's due to a tremendous demand, on the demand side, a tremendous amount. But really, in this case, what I'm talking about is two words: quantitative easing, right? That one term, quantitative easing, through that magic printing press, is the definition of inflation, right? And anybody who challenges that interpretation is absolutely wrong, right? Because we're simply just devaluing the dollar, much like China has done in the past, right? Devaluing their currency. We in the US, we're devaluing the US dollar. However, not against really any other currencies, not yet anyway. But against our dollar, we're actually losing a lot of value to that dollar against inflation, because of inflation, because the Federal Reserve is paying off debt with more compounded accumulated debt. And that's never going to work, because now we're talking about money that practically doesn't even exist. So it's very hard to acknowledge that the money that we pay with, for example, money that businesses and consumers pay back with interest rate payments, interest payments back on their loans, whatever the loans they took due to this crisis, they're most likely not going to be able to pay it back in full, right? The principal, especially the interest payments, some loans are on relief. That's great. But I'm saying an aggregate view, a lot of people are not going to be able to pay back their loans. Right. So what we're going to see is a huge horizon of defaults. And the question really comes down to, when will the United States default? Right? When will we have this currency crisis, which we're about to have? Right? We're about to see the crash of the US dollar. It's already underperforming. While gold and silver, especially recently, has been outperforming. Gold stocks, even GDX, the gold mining ETF, they're all outperforming. And yes, the stock market is actually in what I'd like to call a bear market rally, short-term speculation. Of course, people are really buying into the fact that the economy is progressively reopening. Vaccines are popping left and right, potential ones anyways. But people forget that, first of all, the vaccines, yes, the companies, they submit PR to the public, the catalysts to the public that admit that they are in the process of, trying to get a vaccine. But there's a long road ahead for them, right? There's at least a year ahead road to get this vaccine, to the, in a colloquial context per se, right? To actually, you have to get through all three phase levels of the FDA, right? The bureaucrats at FDA are not going to exploit anything to fast track anything. Unless, of course, it has happened actually. We have fast tracked, FDA things in the past, but it's not like we're going to have it overnight. Much like the stock market looks like it's acting, right? These huge price swings to the upside that we've been seeing off the lows when the Dow was down like 30%. We saw the fact that, when the stock market was going down and down and down, right, the common interpretation was that there are forced margin calls, hedge fund liquidations, general pension fund selling, and people, generally speaking, moving from active to passive investing, right? From aggressive money to safe money, risky money to safe money. And we're seeing that more now than ever, right? Volatility, the VIX is, I think, in 27 or sub 27. And that's pretty damn low, right? So there's really no volatility to support this humongous retracement to the upside in the stock market, right? The Russell 2K is still kind of, there's a lot of stocks in the Russell 2K that are deeply underperforming at new lows. But then you see blue chip stock, well, not really blue chip, but you see stocks like Amazon, and other tech stocks, tech-oriented stocks that are absolutely killing it. They're crushing it. They're making all-time highs. And these executives that hold these options and common stock are making boodle. They're making so much money. That's great and all, and that's part of our free market system, our free market economy. But what happens when our Federal Reserve acts unconstitutionally, in divergence to what the private sector is doing constitutionally, right? The free market economy has been around for 200 years, really since Adam Smith, when he wrote in 1776, The Wealth of Nations, which is a really, really good book. I actually recommend it for anybody that's interested in ever so slightly what I'm saying, because The Wealth of Nations provides a guide to what the economy should be in terms of free flow, in terms of how there shouldn't be any government intervention, right? Why is the government bailing out businesses that shouldn't be bailed out, right? They should be left to fail. That's part of the free market system. We don't just get magic buyouts, non-deservingly. If a company has a weak balance sheet and if they're highly levered in debt, and they're having a hard time financing that debt, then yeah, they should be forced to fail. They shouldn't have any outside help from the government. Especially the fact that these businesses, like I said before, these businesses have to pay back those loans and through interest payments. A lot of them aren't going to be able to do that, especially smaller businesses, right? The local pop shops and the mom and pop shops, the restaurants, hair salons, even retail. There's a lot of trouble here, and people are just lining up for these loans like there's no tomorrow. And the government's more than happy to give it to them. Legislation is more than happy to pass more stimulus. But the problem with that, like I said, is that is debt monetization. That is inflation. We're not even talking about monetary policy yet. This is fiscal policy, and it's tremendous how trillions and trillions of dollars are being added to the balance sheet, right? The Fed's balance sheet, while simultaneously our trade deficits and budget deficits are reaching all-time highs. Even if you discount inflation, it's still the most we've ever seen in history. The velocity of money is actually decelerating at such a tremendous rate. That's why, because the Fed has kind of slowed down their QE. They've kind of slowed down buying bonds and other high-yielding debt. They've slowed down on a daily purchase. They purchase daily, like for example, corporate debt ETFs, junk bonds, anything that's investment grade, but that's on the junk bond scale that has high yield debt, that has a high yield return. So they're basically the only people that are buying up these bonds. And that's a huge problem because nobody else is buying them. So now there's going to be a huge supply glut of these deteriorating bonds, these bonds that are going to go to default. So it's a very dangerous situation. And I think the US economy, in order for it to, what's going to happen really is, we're going to have this currency crisis, along with hyperinflation coming into play, long-term interest rates, which is already starting to happen, right? The 30-year is actually spiking a little bit, while the federal government right now is focused on buying up short-term securities, and thus the yield curve is actually steepening because of that. And I think the 30-year will probably keep climbing higher, we're going to stay at 0% interest rates, right? The Fed funds rate is at like 0.05%. Okay, so we're basically at 0%. The discount Fed window, the FOMC, everybody is within the federal government is trying to buy up the liquidity. The insolvency that was insolvent is now not solvent, is now solvent only because of the fake money the Federal Reserve is actually buying into these credit markets, and credit spreads are actually going to widen to what we saw this before in the crisis, but we're going to see it again, probably to a much higher degree, which is high credit spreads, right? We're talking thousands of basis points. We saw it earlier with junk bonds, a month or two ago. We saw junk bond spreads at 1,000+ bips, and that was a huge deal. But obviously, the Fed came in to tighten those spreads, which they did successfully. But they did it with fake money, right? They did it with money that was freshly printed, and had no business of even being printed. So it's a huge disaster. The Federal Reserve is really accumulating this massive form of debt monetization, and our sovereign debt crisis hasn't even begun, right? The amount of foreign nations that are actually holding the U.S. dollar, the amount of demand for the U.S. dollar. That's why the U.S. dollar is actually not crashing against other currencies per se. Like the franc, the pound, even the euro. But all these central banks, right? The European Central Bank, the Bank of Japan, the Federal Reserve, they all have one common thing, which is, a sort of, no, I don't want to say a liberal view, but I do want to say something that is because, they take these actions due to political gain, due to political advantage. Because let's say, Bernanke in 2008, if he didn't go through with TARP, if he didn't go through with any form of stimulus, if he just let the whole economy and stock market fail like it should have, right, we would have had a much lesser pain and a much stronger recovery after the fact, because we're actually, the government's not intervening with fake money, right? We're not compounding the problem. We're fixing it right then and there. So that would have been ideal, but now it's starting all over again at a humongous scale, biggest scale we've ever seen. And there's really no backing out of it, right? We're already in this mess. The question is, to what extreme scale this will occur. And I think that it's tough to say. Look, I mean, I've been telling my friends, I've been telling my family, I've been warning everybody I talk to, literally, to buy gold, to buy silver, really any precious metal, but specifically gold and silver. And if you want more variance in your returns, I suggested to buy into gold stocks or even gold mining ETFs. However, ETFs are not all that safe, especially like inverse ETFs or even levered ETFs. Those aren't what I would consider a safe long-term hold, because, right, they in the case of Nugget or GDX or UVXY, some of those are great inflation hedges short term, but thing is, they actually roll over their leverage ratios, right, for their individual portfolio holdings. So the derivatives that they hold, that these ETFs hold, these derivatives are representative of that they hold in their portfolio. And so it's really risky to hold that long term, because derivatives are all about time decay, right? Theta. And but anyways, no. But if you just bought physical gold, which a month or two ago would have been really, really hard to get your hands on physical gold, because wholesalers were just buying it all up. Wholesalers were trying to grab it all. But now, there's still not enough attention on gold. There's still not enough demand for gold rather than the U.S. dollar, because of those foreign nations that a lot of countries, for example, have been creating what's known as dollar swap lines, where they literally exchange all the gold that country has, or most of it anyway, for US dollars. So think about not only our country, but all the other countries that are holding these dollars. Think about how they're going to default, right? So this is a systematic chain of events that will occur. It's just, obviously I don't know when exactly this will happen, but I think it will happen soon. I think we will see a massive deterioration of our U.S. economy in terms of inflation, And in terms of really the fact that gold may even become our new world's reserve currency, right? It may regain back that status, thus having the US dollar defaulting, thus having it worthless, which is totally possible, 100% possible. Um, but you know, and a lot of people suggest that, okay, well, there's a lack of supply, there's a limited supply of gold, but there's an infinite supply of the US dollar. So how is gold beneficial to everybody in the world? You just answered your own question. The US dollar has an infinite supply, right? Because of that magic printing press. And that is exactly how we got into this problem over 100 years ago. Not exactly the same way through QE, but through stimulus, through general, uh, you know, for the lack of a better word, modern monetary theory. I mean, what is that? That is just pure post-Keynesian idealists that are trying to create a more creative word for Keynesian economics. No, no, absolutely horrendous. That should not be, no. Austrian economics is, you know, the footsteps of the laws of supply and demand. And, you know, if you master the laws of supply and demand, you'll very much be easily able to adapt to these situations and really solve puzzles in your mind using these laws. And because they're so vital, they pertain to everything and everyone in society. So you might as well get to know it quite well. You might as well get to master it. And once you understand the laws of supply and demand, you'll get to realize that, you know, for example, our country, you know, we used to be the biggest creditor nation in the world, not very long ago either. But now, because of all this stimulus, bailouts, QE, you know, we're seeing exactly the opposite. We are the biggest debtor nation in the world, right? We just surpassed that threshold of $25 trillion in U.S. national debt. The Federal Reserve's balance sheet makes up 30% of U.S. GDP, right? I think our balance sheet is at like 8 trillion almost, or maybe over that, something like that. And don't even listen to unemployment rate, because unemployment rates don't even take into account people on furlough, people that are in retirement, or people in retirement that are looking for jobs. So it's there's a lot of misleading indicators that the government likes to watch. And inflation is in itself horrendously mispriced, in my opinion. I think it should be much higher than it is. And that goes for gold. I think gold should be much, much higher than it currently is. And that goes without saying. Bitcoin, which I do, I do have, I like it because I know people are interested again, because that's all it is. That's all Bitcoin is. Bitcoin is a speculative asset that is not intrinsically valued. There's no intrinsic worth. There's no holding value like gold. Gold has holding value, but Bitcoin doesn't. The only thing you can do with Bitcoin is actually exchange it for more Bitcoin. And, you know, we've created this whole cryptocurrency market based on blockchain technology, which is good technology. But look at Bitcoin itself. It's so out of date. It's old. It's not fast. It doesn't work nearly as well as even any of the other cryptocurrencies out there. And now they're calling it Bitcoin Z, Bitcoin Cash. So all these different Bitcoins, it's creating a fake trade-off, a fake market comprised of coins in circulation that, yes, are limited, like Bitcoin. They are limited in circulation. So it's really just an asset that's based on people buying more Bitcoin. That's how the price of Bitcoin moves up, is people just buying more. And that's what we saw a few years ago. I actually predicted that as well, that Bitcoin would crash from 27,000 to zero. And we actually did see it go to 3,000, not zero, but close enough, right? No, but I actually do suspect, I don't speculate, but I suspect, because I'm not acting on it, that Bitcoin can go pretty damn high. Right there, not only is there a lot of attention on it, but there's an increasing amount of attention on it, right? People are, just average retail traders are just dumping money blindly into Bitcoin because of this psychological conception that someday Bitcoin will be at $100,000 per Bitcoin. So if you have the money to, on a monthly basis to accumulate some bucks into Bitcoin, then go ahead. I don't have any problem with that. I just don't think it should be considered an investment. I think it should be considered a much more risky term, much more risky terminology than an investment. But anyways, so it's, and forgive me for like pausing all the time. I'm just thinking on top of my head here. But, over 40 million jobs have been lost just in the United States. Over 40 million people have filed for unemployment, right? So people are getting all of these checks, and, people have been getting these weekly checks from the government directly. When they wake up, they get $1,200, $800, whatever it may be. They get this money weekly, and it's a lot of money. It's a lot of money for one person. And a lot of people are getting them too, right? Because we said before, people are just lining up for these loans. People are lining up for credit lines, anything and everything that will give them more money. And the problem with that is people don't want to go to work now. People are disencouraged to go to work because they're actually getting paid more from the federal government through these stimulus checks than they would if they were to go back to work. So it's a massive, massive controversy in that respect, in terms of what will happen as a result. And what's going to happen is when these checks stop coming, right? When these stimulus checks stop coming at the end of July, people are going to get really mad, right? Especially with these riots that are happening in about 400 cities, 350 U.S. cities, which is, these riots are scattered throughout the entire United States. And I think it's only going to get worse, but think about how much more angry these people are going to be that were filed for unemployment, receiving these checks. All of a sudden they wake up and say, no more checks. What's happening? What's going to happen to me? What's going to happen with my job now? People are going to want to go back to work, and now they can't go back to work because businesses are trying to cut costs, right? Businesses, that's why commercial real estate is absolutely tanking and has been, because businesses, especially tech companies like Twitter or even Hertz, they're actually deploying their employees to work from home forever. These employees are going to work from home forever because they're technologically oriented / biased. So they don't need a building. They don't need a huge space to waste money on general utilities and rent and all this stuff. Why waste that money that when you could just reinvest it for a larger workforce or for better technology or just to make a better business? And that's what a lot of people are doing. So commercial real estate is actually really, really getting hammered down. And next will come residential real estate, because people's homes are actually right now and has been refinanced, right? People are refinancing their mortgages, especially people that aren't, so to speak, financially healthy, right? Their personal balance sheet isn't too healthy. They may be very levered. They may have a lot of auto debt. They may still have auto car loans, credit card loans. Their credit score to begin with may have not been so well, whatever it may be. They've been refinancing these mortgages. And obviously not everyone, I'm just saying aggregately speaking. People have been refinancing these mortgages, but at extremely low rates. So what's happening here is, as interest rates have been dropping and are going to stay at zero for a long time, people have been refinancing because it's just cheaper to do that. But it's actually going to take a much longer time to pay off these mortgages. And think about the United States. That's exactly the same situation the United States federal government is in, right? We have to pay off this debt. It's not like we could just keep this debt forever rolling. No, we can't. We have to pay back this debt, otherwise we default. And how we do that is through low interest rates, right? We collect, I think, a little over $3 trillion through taxation every year. But the amount that the government spends is almost 3 times that, a factor of 3 times of how much we collect through taxation. And that's the biggest stream the federal government has in cash inflows. And that influx of cash is nowhere near to how much the government actually spends. So, paying off this debt is not only going to be kind of disregarded, but it's going to take forever with these low rates. So that's why we need higher interest rates, to actually encourage saving, to actually encourage people to save and businesses to invest, not the other way around, not to consume, not lower interest rates so people could buy more, lever up and buy more, or consume more, spend more. And that's what under Trump's presidency, we've seen, right? We've seen a humongous exponential growth in consumer spending and government, especially government spending, right? Trump always likes to brag how much he spent on the US military. That's great and all, but with what money? What money did we, over $2 trillion did we have to use to rebuild the US military? Give me a break. We didn't have any money. We freshly printed that money and just made the problem even worse, that much worse. And so it's a pattern of these kind of conservative folks making liberal decisions. And I think that's how it will always be. It kind of always has been in Washington and in the general government. And right, because socialism really is creeping up on this country, and of course through its officials, like our good friend Warren, Pelosi. Oh, we love Pelosi, right? All these people that are stressing for stimulus, added stimulus, infrastructure, everything that is just going to make the problem bigger. It's as simple as that. The amount this country spends relative to how much it saves is a tremendous gap. That ratio is tremendous, right? So, that's kind of all I wanted to point out here, just to kind of update on my predictions and how going against the herd can be really, really tough, but it's something that must be abided by, because that's what contrarian investing is, right? You're going against the herd, and you have to have not only the stamina to follow through, but what's the word I'm looking for? But also, anyways, it's really contrarian investing, at least to me, is about going against the herd. But not only that, but in a rational way. It's one thing going against the herd, just going at it blindly. But if you have a rational base or case behind your contrarian position, then that's justifiable, right? That's justifiable to you. That's justifiable to anybody else. And, it's also important to point out that, people protect themselves, like we said, from moving to active to passive investing, but it's not really just that. It's people also moving out from the stock market to cash. People are moving just to cash. And when people realize that the US dollar is actually losing value, their purchasing power is going to be wiped out right across the board. And they're not going to be able to do anything about it because they weren't backed by gold. They didn't have any gold to hold on to. Right. So, their buying power just vanished in thin air. So I think not too good of stuff to, I know I'm a huge bear, as you could tell, obviously. But this stuff must be said. It must be said to the public. And I've been saying this for a very, very long time, as to what how the federal government is acting unconstitutionally to quote unquote protect this country from financial insolvency. And they're actually making that problem themselves. Nobody else is adding into that problem. It's just Washington. Right. So that's it for today, everybody. I hope you enjoyed listening. I hope you learned something. Okay. So,